Be speed the insight you need. I'm Junfeng. 4.8%. That's China's first quarter economic growth rate announced on Monday. It beat the 4.4% forecast by a Reuters poll. It was also stronger than the 4% growth rate in the previous quarter. But it's below China's annual target of 5.5%. It reflects pressure from COVID-19 pandemic, the impact of quarantine and restrictions. Actually, China's economy had a bright spot in the first 2 months of the year. Retail sales rose 6.7% in the January to February period compared to a year ago. Industrial production jumped 7.5%. Investment in fixed assets jumped 12.2% during the same period from a year ago. But the good start didn't continue in March when the worst COVID-19 outbreak since 2020 hit Jilin, Shanghai, and a number of other regions. The restrictions used to contain the Omicron variant disrupted business activities and supply chains. Analysts from Chinese security firms predicted that Shanghai's quarantine had slashed the country's first quarter GDP by around 1 percentage point. During the same time, China is also resolving debt problems in the property market. The task to curb any remaining risks may take some time. Apart from the domestic challenges, two big overseas uncertainties are looming. Firstly, the Russian-Ukraine conflict has caused commodity prices to surge. As an economy reliant on imports of oil, iron ore, copper, nickel, and soybeans, China is facing imported inflation pressure. And secondly, the US has started to tighten its monetary policy, which is followed by European central banks. So money outflow pressure is growing, creating financing problems for China's tech startups. Earlier this year, China set an annual growth target of 5.5%, a needed expansion to secure employment for tens of millions of job seekers. Now, with stronger domestic and international headwinds, more easing policies are on the cards. On April the 15th, China cut its reserve requirement ratio, or the amount of cash that banks must hold as reserves. The move will release 530 billion yuan, or $84 billion in long-term liquidity. China is also expected to cut its key lending rate in the second quarter, but the Chinese central bank has to carefully watch the pace of US rate hikes in order to avoid more pressure of money outflows. The government has stepped up local bond issuance to fund infrastructure projects and cut taxes for businesses. In March, the Finance Ministry announced some small firms' income tax will be cut from 25% to 20%. Premier Li Keqiang says tax cuts and rebates will total 2.5 trillion yuan this year. Small companies offer some 80% of jobs in China. Actually, the situation is improving. Jilin province is fully declared virus-free and has reopened. Shanghai has eased restrictions in some parts of the city, and some key companies there have resumed operations. I believe normality will resume soon, and China's annual growth target is achievable.